Are the final months of 2025 about to unleash the biggest move we've ever seen in Bitcoin and Ethereum? Are we just weeks away from a wave of money that changes this entire cycle? What happens when the largest asset manager in the world, BlackRock, the company that essentially owns the entire world, starts to buy up assets with a fixed and ever-shrinking supply? The price can only go one way. This video is your ultimate guide to BlackRock CEO Larry Fink's shocking flip on Bitcoin, Joseph Chalom's roadmap for Ethereum, and Joseph Lubin's call that Ethereum could 100 times. The next few months could set Bitcoin and Ethereum's rise for the rest of this decade. Bitcoin has taken headlines with record inflows into ETFs, but the real action is building under Ethereum. From Wall Street moving assets on-chain, to stablecoins hitting new highs, to treasuries locking up supply, everything is lining up for an end-of-year crypto breakout. In this video, we'll break down everything currently happening and why the end of 2025 may be remembered as when the crypto tsunami finally hit. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now let's dive in with what BlackRock CEO Larry Fink just said about Bitcoin.
And I was just learning all the different applications. And I came to the view that there's a lot of legitimacy with Bitcoin. Certainly the technology around, the blockchain around Bitcoin was pretty unrivaled, and it still is. And I became a believer. Most of BlackRock's business is based on long-termism. And I always raise the question, why would anybody invest in a 20 or 30-year outcome unless you believe the 20 or 30-year outcome is going to be good? Because if you didn't believe in over a 20, 30-year horizon that those long-term investments would be better, you would keep all your money in a bank account or in a mattress. And so, all our business is based on hope. And I said, you know what, Bitcoin is a currency of fear. You own Bitcoin because you're frightened of your security in your country. You own Bitcoin because you're frightened of the debasement of your currency. But so it's an evolution. And I'm proud of admitting that, okay, I was wrong.
When Larry Fink, the chairman and CEO of BlackRock, first dismissed Bitcoin years ago, the traditional finance world felt validated. If the man running the world's largest asset manager thought crypto was a distraction, then surely it could not be taken seriously. But in 2025, the story is very different. Fink has gone from skeptic to one of Bitcoin's most vocal institutional supporters, openly admitting he was wrong about dismissing the asset and calling it a legitimate part of the financial system. In one of his recent interviews, Fink described Bitcoin as a currency of fear. In his words, people turn to Bitcoin because they are frightened of what is happening in their country, or they are worried about the debasement of their local currency. In economies like Argentina, Turkey, and Nigeria, collapsing currencies have driven millions of people to Bitcoin and stablecoins because they are more trustworthy than the national fiat. Fink's observation that long-term investments are rooted in hope while Bitcoin is rooted in fear captures the dual forces driving adoption. Fear pushes people out of failing systems while hope pulls them toward assets that promise security over decades. The significance here is not that Larry Fink believes Bitcoin is an emotional hedge. The true revelation is that BlackRock, under his leadership, has gone all in on providing institutional-grade access to this asset. In early 2024, BlackRock's spot Bitcoin ETF became one of the fastest-growing exchange-traded funds in history, absorbing billions in inflows within weeks of launch. By mid-2025, it had cemented itself as the dominant vehicle for pensions, endowments, and sovereign funds seeking exposure to digital assets. Fink's shift did not just mark a change of opinion, it paved the way for trillions of dollars in global capital to find its first regulated path into Bitcoin. And the timing could not be more consequential. As governments wrestle with record debt levels, interest rates under pressure, and persistent liquidity crises, institutional investors are being forced to rethink where to store long-term wealth. Bonds, once the backbone of conservative portfolios, no longer provide real yield after inflation. Real estate faces demographic and political headwinds. Gold remains relevant but stagnant. Bitcoin, by contrast, offers both scarcity and growth. Fink's acknowledgement that he underestimated this reality is nothing less than an institutional green light for Wall Street and beyond. But Larry Fink is not stopping with Bitcoin. While his focus has made headlines for legitimizing Bitcoin, BlackRock's growing involvement in Ethereum suggests a tsunami is building not just for Bitcoin, but for the entire crypto asset class. To understand why, we need to move beyond Bitcoin as digital gold and look at Ethereum as digital infrastructure. Joseph Shalom posted on X that SharpLink looks at Ethereum through a simple valuation lens. Over the past 5 years, Ethereum's market capitalization has tracked the growth of high-quality liquid assets secured on-chain. These include stablecoins, tokenized real-world assets, and decentralized finance tied to blue-chip collateral. He cited the Consensus Trustware report and wrote that for roughly every $2 of these assets parked on Ethereum, Ethereum's market cap has risen by about $1. Chalom then pointed to growth paths that can push this relationship further. Stablecoins currently sit around $275 billion with a projection to more than $2 trillion as cited by Secretary Bessent. Tokenized real-world assets are around $30 billion today, with Boston Consulting Group estimating a rise to between $4 and $16 trillion. If Ethereum secures a meaningful share of this activity, valuation pressure on the native asset follows because security, gas, and collateral tie back to Ethereum. This is where the sharp contrast with Bitcoin comes into play. Bitcoin captures flows as a store of value. Ethereum captures flows by embedding itself in the plumbing of finance, and BlackRock, along with JP Morgan and other Wall Street titans, has already begun building on Ethereum rails. JP Morgan, for example, has been running Ethereum-based private networks since as early as 2014. What Larry Fink sees in Bitcoin as a hedge, Joe Lubin, Ethereum co-founder, sees in Ethereum as the engine of an entirely new economy. Joe Lubin posted on X that his vision is more radical than even Tom Lee's bullish calls for $30,000 Ethereum. In his words, Ethereum will likely 100 times from here. Probably much more. He argued that Wall Street will stake, run validators, operate on Layer 2 and Layer 3, participate in decentralized finance, and write smart contracts for agreements and instruments. He also dismissed the claim that Layer 2 solutions cannibalize Ethereum, pointing to linear and proof of burn as examples of how scaling networks funnel more demand back to the base layer. Every transaction that happens on Layer 2 ultimately settles on Layer 1, which strengthens Ethereum as the ecosystem expands. In Lubin's framing, decentralized trust functions like a commodity, and Ethereum is the highest octane version of it. And institutions are acting with conviction. In that same discussion, it was revealed that Bitmine Immersion has become the largest corporate Ethereum whale. The firm recently pushed its holdings around $10 billion. Their target is to control 5% of all Ethereum in circulation. This is not speculation, it is a treasury strategy. Just as MicroStrategy became the face of corporate Bitcoin, Bitmine is writing the playbook for corporate Ethereum. When the biggest treasuries are locking up Ethereum supply and ETFs are absorbing billions more, scarcity collides with demand in a way that only has one logical outcome: higher prices. So while Larry Fink's confession that he underestimated Bitcoin marks a turning point for Bitcoin, the broader story is that Wall Street and the corporate world are preparing to run directly on Ethereum. Stablecoins, tokenized treasuries, decentralized trust, all of it converges on Ethereum. And if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in. Tom Lee, co-founder of Fundstrat and a veteran Wall Street strategist, has described what is unfolding around Ethereum as its 1971 moment. The reference matters. In 1971, President Nixon severed the link between the United States dollar and gold. The gold window closed and the modern financial system entered an era of floating exchange rates, rapid innovation, and an explosion of credit. Lee sees Ethereum in a similar position today. It is no longer a speculative side experiment, but the settlement layer that can host trillions of dollars in assets and financial logic. That shift creates the possibility for a repricing of historic scale. Ethereum today secures stablecoins, decentralized finance applications, and an early wave of tokenized real-world assets. The valuations look modest when compared to the global system. Stablecoins are in the hundreds of billions, real-world assets in the tens of billions, yet the projections point far higher. Secretary Bessent has estimated stablecoins can grow above $2 trillion. Boston Consulting Group has forecast $4 to $16 trillion in tokenized real-world assets. Those flows, if they anchor to Ethereum, deliver compounding demand for block space and for the native token. Joseph Chalom's ex-post outlined the valuation logic in clean terms. He noted that for every $2 of high-quality liquid assets secured on Ethereum, the market capitalization of the token has increased by about $1. That historical relationship offers a direct metric. If assets secured on Ethereum scale into the trillions, the token's market cap is positioned to respond in proportion. It does not guarantee precise multiples, but it shows the linkage between real usage and valuation. That framing makes Ethereum attractive to institutions that think in balance sheets and correlation ratios rather than in memes. Tom Lee ties this to the shift that happened in 1971. When the gold peg was cut, it unleashed capital. Central banks, treasuries, and private actors were free to innovate. Derivatives markets grew, foreign exchange exploded. A new generation of financial instruments emerged. Ethereum's base layer, in his analogy, is about to serve as the settlement platform for the digital version of that explosion. Stablecoins will be the programmable cash. Tokenized securities will be the credit instruments. Artificial intelligence models will interact with both as autonomous agents. The settlement and validation of these processes will rely on Ethereum. In that setup, demand for the native token cannot remain static. Joe Lubin's ex-post went further. He wrote that nobody is bullish enough because nobody can truly fathom the speed and scale of a decentralized economy blended with human and machine intelligence. He sees Ethereum not just as infrastructure, but as the commodity of decentralized trust. Trust becomes programmable. Trust becomes scarce. Ethereum becomes the refinery that produces it. When demand for trust rises in digital markets, demand for Ethereum rises in tandem. Lubin framed this as an eventual flip over other commodities. If oil powered the industrial age, trust as code will power the digital age. Tom Lee and Joe Lubin are not aligned on exact numbers. Lee places near-term Ethereum targets in the tens of thousands of dollars. Lubin claims 100 times growth or more. Both converge on the same conclusion: the path forward is up. The reason is not sentiment. The reason is that assets, contracts, and capital are moving on-chain in increasing volume. When the base layer secures that movement, the value of the base asset grows. This is what Lee calls a 1971 moment. It is the point when the system itself resets and new valuations take hold. The story of Bitcoin and Ethereum is often told as rivalry. Bitcoin as digital gold, Ethereum as decentralized finance. Yet the real story, supported by Larry Fink, Joseph Chalom, and Joe Lubin, is Convergence. Both assets answer different questions that arise in the current system. Bitcoin answers the question of monetary debasement. Ethereum answers the question of trust in financial processes. Together, they create a dual engine that pulls in capital from legacy stores of value and from legacy infrastructure. Larry Fink's framing of Bitcoin as a currency of fear illustrates why it fits the monetary hedge role. Citizens under pressure from inflation or capital controls seek it out. Investors managing sovereign risk are allocating to it. Central banks may not yet hold it on their balance sheet, but they cannot ignore its liquidity pool. At the same time, Ethereum gains traction as the ledger for assets and agreements. Chalom's framework showed that Ethereum's value has already tracked assets secured on-chain. The convergence is visible in flows. ETFs have already absorbed nearly 5% of Ethereum's supply since approvals began. Corporate treasuries like Bitmine Immersion are targeting ownership stakes measured in percentage points of the entire float. On the Bitcoin side, BlackRock's spot ETFF has grown into one of the largest exchange-traded products in history. These are not retail dynamics, they represent the same slow but powerful current that reshaped markets after 1971 when gold no longer capped monetary expansion. What makes this cycle different is that both engines are running at the same time. Bitcoin draws flows from savers who fear debasement and from investors who need a scarce hedge. Ethereum draws flows from institutions that need programmable trust and scalable settlement. One narrative feeds on macro weakness. The other narrative feeds on technological adoption. The result is not a choice between them, but a reinforcement. Bitcoin holders look to Ethereum for yield opportunities and settlement. Ethereum users hold Bitcoin as collateral and long-term store. The more the two interact, the stronger the case for both. The tsunami image captures this convergence. A tide is building, fed by multiple sources: sovereign debt risk, inflation anxiety, stablecoin growth, tokenized asset issuance, corporate treasuries, institutional ET/EFF flows. Each current alone is significant. Combined, they form a wave that reprices both Bitcoin and Ethereum far above current levels. Tom Lee said that Ethereum is experiencing its 1971 moment. Joe Lubin said that 100 times growth is plausible. Larry Fink admitted he was wrong about Bitcoin and now describes it as legitimate. Joseph Shalom laid out a valuation link between assets secured and token price. Each of these voices speaks from a different seat of power: a Wall Street strategist, an Ethereum co-founder, the head of the world's largest asset manager, a senior BlackRock executive. Together, their views converge on one message: a financial reset is underway, and Bitcoin and Ethereum are its twin beneficiaries. This is why the tsunami metaphor fits. It is not a spike or a trade. It is the force of capital migration that sweeps away old pricing and leaves a new shoreline. The shoreline in 2025 and beyond may look like a world where Bitcoin is digital gold and Ethereum is digital trust. Both together, not in rivalry, but in reinforcement, pulling trillions of dollars from bonds, real estate, and gold into assets that cannot be diluted and cannot be faked. When people talk about Ethereum, the conversation often drifts toward speculation on price or debates over network fees. Institutions see something else. They see a settlement system that can handle trillions of dollars in assets with more transparency and efficiency than the legacy stack. Joseph Shalom, a senior BlackRock executive, posted on X that Sharpling looks at Ethereum through the value of the assets it secures. He pointed to stablecoins, tokenized real-world assets, and decentralized finance built on strong collateral. Chalom noted that Ethereum's market cap has historically scaled at about $1 for every $2 of these high-quality liquid assets on the chain. For him, the logic is simple. The more assets move onto Ethereum, the more valuable the network's native token becomes because the token secures settlement. Stablecoins show how this process unfolds. Today, more than $275 billion in stablecoins circulate on Ethereum and other networks. Secretary Bessent has said this could expand past $2 trillion. That forecast does not live in the abstract. Dollar stablecoins have already become critical in emerging markets like Argentina and Nigeria, where local currencies cannot hold purchasing power. Even in developed markets, stablecoins are creeping into payments and settlement rails. PayPal launched its own dollar stablecoin in 2023. Visa has tested settlement using USDC on Ethereum. These pilots are not fringe experiments. They are signals that global payments firms see programmable dollars as an inevitable part of their business. Tokenized real-world assets add another dimension. Government bond markets total more than $120 trillion globally. Equity markets add more than $100 trillion. Derivatives climb into the quadrillions. If even a small share of that activity shifts to tokenized instruments, the settlement venue becomes a defining question. Boston Consulting Group estimated between $4 and $16 trillion in tokenized assets by 2030. Early pilots are underway. Euroclear tested tokenized government bonds. HSBC launched a tokenized gold product. The Monetary Authority of Singapore has run a series of tokenization experiments involving multiple banks. The pattern is clear. Institutions are not asking whether tokenization will happen, they are asking which rails will carry it. Ethereum already has the liquidity, developer base, and trust where needed to host those flows. Chalom's point ties this institutional momentum back to Ethereum's market cap. If the network continues to secure more assets, valuation follows. That logic resonates with Wall Street because it mirrors how they already think about balance sheets. An asset that reliably scales with usage is attractive. An asset that underpins trillions of dollars in financial activity becomes essential. That is the framing that makes Ethereum less about speculation and more about infrastructure. BlackRock itself has signaled interest in Ethereum exposure. While the firm's Bitcoin ETF captured headlines in 2024, filings and reports suggest Ethereum products are next in line. Other asset managers like Fidelity and VanEck have already sought Ethereum ETFFS. Each approval brings regulated inflows similar to what happened with Bitcoin. Once treasuries, pensions, and insurance funds can buy Ethereum through ETFs, the pool of potential capital expands dramatically. Institutions that cannot hold native tokens for compliance reasons will still be able to allocate. That unlocks new buyers who are structurally restricted today. The history of financial innovation suggests adoption can accelerate quickly once rails exist. After 1971, when the gold peg was cut, derivatives markets grew at speed because institutions needed hedging tools in a floating rate world. Ethereum's rise as a settlement layer offers a similar catalyst. Once a compliant product like an ETF exists, inflows can grow from billions to tens of billions. If Chalom's ratio holds, those inflows anchor to assets on-chain and compound the valuation pressure on Ethereum. Institutional adoption is one driver of Ethereum's valuation. Corporate treasuries are another. Bitmine Immersion provides the clearest example. As reported, the company has accumulated more than 1.86 million Ethereum, worth over $8 billion, equivalent to 1.5% of the entire supply. The stated goal is to own 5% of all Ethereum in circulation. That level of accumulation is not trading behavior, it is treasury policy. The move echoes MicroStrategy's strategy with Bitcoin, where a corporate entity converted cash reserves into a scarce digital asset. The logic is defensive and offensive. Defensive because the company shields reserves from inflation and currency debasement. Offensive because it positions itself ahead of a potential revaluation wave. The implications extend beyond Bitmine. If one corporate can credibly pursue a target of 5% of supply, others can follow. Ethereum offers unique advantages for corporate treasuries. Beyond scarcity, it powers the applications those corporates may use. Stablecoin settlement, tokenized invoices, decentralized finance liquidity all run on Ethereum. A treasury position in Ethereum doubles as both a reserve asset and a stake in the infrastructure a business relies on. That synergy could drive adoption in industries as varied as finance, logistics, and technology. At the same time, regulated products like ETFs are absorbing additional float. Since approvals began, Ethereum ETFs have taken in billions of dollars and already control a measurable share of circulating supply. When corporate treasuries like Bitmine accumulate aggressively while ETFs absorb retail and institutional inflows, the available liquid float shrinks. Ethereum's issuance is already net deflationary at times due to burning from transaction fees. A shrinking float combined with growing demand creates textbook conditions for upward price pressure. This supply squeeze can amplify the valuation effect described by Chalom. If assets on-chain grow in the trillions, demand for Ethereum rises. If treasuries and ETFs reduce the available float at the same time, the price impact intensifies. Scarcity collides with utility. That combination is rare in financial history. Gold has scarcity but limited utility in modern finance. Oil has utility but variable supply. Ethereum has both. Institutional signals confirm this trajectory. In July 2025, global banking consortiums in Singapore and Europe concluded multi-month pilots for tokenized government bonds and repurchase agreements. The chosen settlement rails included Ethereum and Ethereum-compatible networks. The results showed reduced settlement times, lower counterparty risk, and programmable features impossible in traditional systems. When these pilots become production systems, the base layer securing them gains long-term demand. For investors, that demand translates to valuation. The broader picture ties back to trust. Joseph Lubin wrote on X that Ethereum is the highest octane commodity of decentralized trust. In his view, trust is the scarce resource of the digital economy. Institutions accumulating Ethereum, whether through treasuries or ETFs, are effectively stockpiling trust. They are securing their ability to operate in a future where agreements, payments, and collateral all exist on decentralized rails. That explains why Lubin insisted Tom Lee's $30,000 target is not bullish enough. If institutions are fighting for ownership of a commodity that underpins digital trust, upside is not linear. The market is already reflecting this shift. Liquidity on decentralized exchanges continues to climb. Layer 2 solutions tied to Ethereum are processing record numbers of transactions. Stablecoin supply is breaking new highs. Each of these indicators confirms that adoption is broadening, not narrowing. When adoption broadens and float tightens, the revaluation is only a matter of time. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.